In this video, I'll be deconstructing the argument in regards to volume of creative on Facebook. Now, I'm very much so in the camp of the fact that you need to maximize the amount of creative volume that you're putting into the account, and that 90% of brands are putting nowhere near the amount of creative that they need to, as well as the diverse set of creative that they need to get the best performance possible and continue to scale up the account. Now, with that being said, most people take that advice, run with it, and completely destroy their account because of the way that the profit and loss statement is set up and the way that creative production ties into actual return on ad spend. So in this video, I'm going to be decomposing how creative production ties into expected gross profit out of an ad so that you can have a better understanding and you can run this math yourself on your own brand as to whether it is time right now to scale up volume or whether you should maybe hold off and reevaluate your current creative production process and your costing in that area before you go and just crank up volume and hope for the best. So what we have on the screen here is one of our internal creative analysis tools. I've hidden all sensitive data, so this is actual real account data of a Meta account. On the x-axis, we have the date in which an ad was launched, and on the y-axis, we have the total summation of spend through that individual ad. What we've done is we've deemed a point or a threshold point in which anything over that level of spend is a high performer. Now, there is a built-in assumption into this entire model, which is that ad spend is a proxy for performance. That is generally true if you are letting Facebook do the media buying and distribute budgets as it wants, or if you have an actual media buyer in there adjusting budgets across individual ads. Either way, as long as you're okay at media buying, this should hold relatively true, which is that if you go and put $20,000 to an ad, it's probably a high performing ad. If you go and turn an ad off after $400, it was probably a very poor performing ad, or Facebook didn't want to distribute spend to it. And so because of that, we can take all of these dot points, we can divide the winners by the total amount of dots, and we can find the high performing hit rate. So what percentage of ads that we launch into the account are deemed a high performer? Now, for context, where we're getting this threshold is we're looking at the standard deviation of the data set, and we're going one standard deviation above the mean. And that is what we're determining as a high-performing ad. And so if every ad that we launch, we know 7% of ads perform well. Okay, well, the immediate conclusion after you run this analysis is we just need to increase volume. If we know that 1 in every 13 to 14 ads that we put into the account is going to work and spend at least $6,000 in spend, we should just crank up ad volume. And that's true, especially if you can maintain the level of quality that you've had over the last year, and you can assume that all future production will at least maintain the minimum bar of quality that you had previously, then you should be able to significantly scale an account up with that assumption and with those future action items. With that being said, there's a really important concept to understand that goes one level deeper, which is if we know on average how much an ad spends, which in this particular account is really high, it's way higher than your account probably will be if you're watching this video, is $1.7 thousand. Normally this is closer to like $500 an average ad gets. And we know that on average, we have a return of a 2.3 on this particular account. I know they have a 2.3 acquisition rate. Then we know the expected value of an ad. We know that if we launch an ad into this account, assuming that the quality maintains at the average of the historical data, that we should generate $4,000 in revenue. Now, we can also take that down to gross profit. And so we can just minus off cost of goods and we can minus the ad spend. And now we can have an expected gross profit of launching an individual ad into the account. And so you can start to look at ads as individual units that are generating X ROI, which is the expected gross profit. And therefore, if we can go and, for example, introduce 30 ads into the account this month, then we should be able to generate $20,000 in new gross profit out of those ads. And that should generally hold as you scale up volume, assuming that you're maintaining quality. Okay, it's all well and good. And you're probably watching this video thinking this is just one big argument for why you should just max out volume as quickly as possible. But this isn't necessarily true. You're not actually making $20,000 here. And the reason you're not making $20,000 is there's a cost associated with ad production. There's a cost associated with the ideation. There's a cost associated with the actual creation of the asset. There might be a cost associated with the physical production, if it's a video or if you have to shoot new RAWs for images. And there's also a cost of the media buyer uploading and then continuing to analyze those creatives over time. Now let's take the media buyer out of it for a second and let's just look at ad production and everything else that I mentioned. Okay, well, if we know we have an expected gross profit of $655, this means that we need to produce ads for less than $655 or you lose money. Now, $655 is quite high, and most people are thinking we definitely make ads for less than $655, and most people do. And that's why this particular e-commerce brand prints money, because they have a crazy expected gross profit out of each individual ad unit that's launched. And so we pretty strictly only run videos for this brand. And the only reason that we're able to do that is because they have such a high expected gross profit out the back end. If this was down at $200, $300, we wouldn't even be able to launch videos because the cost to create a video is too high. It's above $200. And so we would have to move completely into statics, or we would have to completely change the creative process so that we can produce a massive amount of statics at very low cost. And this is what we actually do internally now. And so we've built out our own graphic design team in which we are optimizing for the lowest cost of production per each individual asset through economies of scale. And any business owner watching this knows this fundamental concept, but I'll lay it out anyway, which is that if you go and get a graphic designer to make one static ad, it's probably going to cost, let's put it together and just say for easy math, it's going to cost $100. And that's the time to open the file, put it together, choose the images, read the brief, provide it to you, get feedback, etc. If you bump that to 2 static ads, there's an incremental jump that isn't equal to the first cost. So this isn't going to jump to 200. This might jump to like 170, because now there's going to be a little bit of efficiency gained in opening up the software, moving the images around, reading the brief. Now you're technically reading the brief for 2, but it's going to be a little bit shorter. And then this obviously continues as you continue to scale. There's obviously a point of diminishing returns, which we're actually trying to figure out internally, but this will now not jump by $70. It might only jump by $50. And so it starts becoming per unit much cheaper to do volume output than to do less and hope for better quality. And so you need to be very, very aware of this when you go into creating your creative production process that's going to facilitate the ramp up in volume. Okay, because most people hear this, that all the arguments I've just laid out about why they should just crank up volume, and they go, okay, cool. Next month we'll drop $5,000 on UGC creators. That'll get us 6 videos. We'll go and get a graphic designer off a freelancing website. We'll get them to do 10 statics. And then we'll go here, and actually also you guys will work with you, and maybe you guys can make us 20 statics as well. And then all these costs go into production. It's actually kind of unclear how much was spent to make these 60 ads for next month. And then what makes it super unclear is that all of those expenses go and hide themselves in the OpEx line item. And so rather than this being included in the ROI, rather than this being layered into marketing expenses within your profit and loss statement, and as long as you're structuring that correctly, you should have marketing and advertising spend segmented out of operating expenses so that you can calculate contribution profit. Contribution profit, when you do this exercise, launch 60 new ads next month, make sure that they're at a standard of quality that's helpful, your contribution profit will go up. Your marketing efficiency will go up. Your volume will go up. But you might make less money all the way down at the bottom of net profit because the cost of production outweighed the gain in contribution profit. And so you need to make sure that you know what your expected gross profit outcome is of a new ad, given the average of historical data. And then you need to make sure that if you're going to go and crank volume up, that you have very tight cost controls over your cost to produce an ad. You need to make sure that the cost of production is less than the expected gross profit, or you will simply just scale negative profit contribution into the P&L. And you'll get volume, your revenue will go up, but you'll suddenly decline sharply in terms of profitability. You'll be wondering why, and it's because of all of that cost of production that you're layering in to facilitate you achieving scale in this particular instance. So you don't have a fancy sheet like this that's aggregating data in the background. What exactly can you do? Well, you need to figure out, number one, what your percentage high performing rate is. This requires deduplication of ads. The reason why I'm not just finding this in the meta ad dashboard is because when you duplicate an ad, generally the naming convention does not stay the same. And so you need to make sure that you consolidate all duplicate ads and then get a real high performing hit rate. If you just do this with deduplicated data, the high performing hit rate will be tiny. It'll be 1 to 2%, which isn't an actual reflection on your actual hit rate. Then number two, you need to find the average amount of spend that goes through each individual ad. And then from that, and in fact, you technically don't even need the high performing hit rate. You just need the mean, how much spend on average goes through an ad, deduplicate the data as I mentioned previously. Then what's the average acquisition mirror? What's the average ROI? Or what's the average ROAS? You can use any one of those metrics. They should all relatively correlate. And then you know expected value. And then from expected value, you get to expected gross profit just by minusing off and I'll show you the formula, minus off the ad spend, and then just minus off whatever cost of delivery percentage they have. And there you go. And now you have a figure that you can use to be able to guide yourself in the cost of production that you should restrain yourself to if you're going to crank up volume. Now, for a lot of people, you're going to run this math, it's going to say $100, or it's going to say $60, $70. I say it all the time when I order brands and do this analysis. And so the question then becomes, what do we do? There's two different parts. Number one, you go down the static route and you look at maximizing static volume, achieving economies of scale. You can realistically start making statics at $20 to $25 if you really have a production process in place that makes sense. Or number two, you need to fundamentally change the approach that you've had in the account over the last 12, 24, 36 months, whatever data set you're looking at, because what you have done historically does not work. And so you need to change the mean. You need to change what you have been doing. Now, maybe that's that you've been doing statics for the last 3 years and they simply do not communicate the value proposition of your product well. And so you do need to pivot into video and hope that video has a higher expected gross profit than the average static. Incredibly high risk associated with that kind of move, but it may be a strategical change that you need to make. And so they're the two different routes that you need to go down when you run this math and the number is tiny. Now, if the number's high, the higher this number, the better. You're in a good position and you can probably scale a lot faster and your brand's positioned in a way where you're going to be really successful on Meta. So make sure to go calculate this figure, calculate the mean, do the quite simple math here, and then you can decide on whether you can crank creative volume up or whether you need to reassess the creative production process first, get that dialed in, and then start ramping volume.